Is GameStop ever going to go back to $400 plus? My guess is no, but honestly, I have no idea. This video is not going to be about that. In this video, we're going to talk about GameStop as a business, its future prospects, and what I think is a fair price for the stock. I decided to take a look at GameStop stock when I got involved in the whole GameStop and WallStreetBets situation. I was a little late to the party and unfortunately I lost $13,000 in the process. I made a video about my experience. I'll put a link to that video in the description below and I'll also put a link up here. The fact that I lost $13,000 should be very bad to my credibility, so take this video with a giant grain of salt. I'm not an expert, I'm just sharing my own opinion. If you decide to invest, do your own research. Anyway, through the process of losing that money, I learned a lot about the company as a whole, and I thought it'd be a good idea for me to share what I learned. I'm gonna start off with what I like about the company, what I dislike about the company, and then I'm gonna end with looking at their financials and what I think is a fair price for the stock. Starting off with what I like, Ryan Cohen recently acquired a 13% stake in GameStop, and on January 11th, GameStop announced that Ryan Cohen and two of his partners will be joining the GameStop board. A little bit about Ryan Cohen. Ryan Cohen is the co-founder and former CEO of Chewy. In 2017, he sold the company to PetSmart for $3.3 billion, and today in 2021, the company is worth a whopping $44 billion. Even though he did step down in 2018, he helped build the foundation of that company so that Chewy is what it is today. So the two other people he brings to the board are Alan Attell, who was the chief marketing officer of Chewy, and Jim Grube, who is the former chief financial officer of Chewy. Together, they hold 3 of the 9 seats on the board, and they probably have influence over another 2 or 3 seats on the board. So you could probably argue that right now they have control of the board. Why this is important is that the CEO of a company is really just an employee of the company. He is the top employee, but really the CEO answers to the board. The board can ultimately direct the executive team, including the CEO, and they have the ability to fire and replace the CEO or the executive team. I bet that they're just waiting for the CEO or CFO to screw up at this point, and then they can just swoop in and take their spots, which honestly would be really great if that happened. Another great thing happening at GameStop is that they made some really promising hires. On February 3rd, GameStop announced that they made 3 key hires. They hired Matt Francis as the new Chief Technology Officer. Matt Francis was the former engineering lead at Amazon Web Services, and he was the VP of Product and Engineering at Zulily. They also hired Josh Kruger as the new VP of Fulfillment. Josh was also a former Amazon employee, and he also had VP roles in fulfillment and logistics at QVC and Zulily. And then lastly, they hired Kelly Durkin as the new Senior Vice President of Customer Care. Kelly Durkin was the former Vice President of Customer Service at Chewy. While she was at Chewy, she helped establish Chewy's Net Promoter Score of 86 in 2018. The Net Promoter Score basically measures how likely you are to promote a good or service to a friend or family member. Anything over 80 is considered world-class. And again, Chewy in 2018 had a Net Promoter Score of 86. A company is just a collection of people, and the quality of the people who work there eventually determine the company's value. Now that there are obviously talented people that have a lot of experience in e-commerce, I think that there is real hope for GameStop because e-commerce is going to play a very important role in GameStop's future. Even before these new hires, we've already seen that GameStop is becoming more of an e-commerce business. They've been reporting a 200 to 300% year-over-year growth in their e-commerce segment over the last couple of quarters. E-commerce already represents 25% of GameStop sales, and now with these new hires, I could definitely see e-commerce becoming 50 to 70% of its sales long term. Additionally, I think that these new hires are going to eventually establish a process for customers to buy and sell used games online, meaning that eventually customers will be able to sell and ship their used games from home in exchange for cash or store credit. This is going to give a big boost to their e-commerce business as well. It's not super clear yet if e-commerce has better margins compared to brick and mortar. In their most recent quarter, GameStop blamed e-commerce as part of the reason why their margins decreased, but I would imagine that long-term e-commerce sales should have higher margins than brick and mortar because of the economies of scale, and just in general, games should be pretty cheap to ship. In October of 2020, GameStop entered into a partnership with Microsoft where GameStop would receive an undisclosed revenue share of digital downloads from Xboxes that are purchased at GameStop. So if someone goes into a GameStop and purchases an Xbox, then they go home and buy a digital game, then GameStop would receive a percentage share of that sale. I think that Microsoft seriously got the sucky end of the deal here. In exchange for the revenue share, all GameStop had to do was purchase services and hardware from Microsoft that they probably were going to purchase anyway. Now, GameStop has a recurring stream of revenue that pretty much has a 100% profit margin. Let's move on to what I don't like about the company. I actually used to be a GameStop stockholder a couple years ago, but unfortunately I sold before this whole short squeeze situation. But one of the main reasons why I sold is because of some of the terrible stories that I heard from former employees about the toxic work environment. And after doing some more research, it seems like even now, the toxic work environment still exists. According to Glassdoor, GameStop stands at a 2.9 out of 5 rating, which is not the worst that I've ever seen, but it's pretty bad. The Glassdoor rating is bad enough that when I search Google for the worst companies to work for, the top link shows an article for the 22 worst companies to work for, and GameStop stands at number 15 on that article. Basically, the main complaint is that the pay is too low. In order to get paid more, you have to hit these unrealistic sales quotas. In order to hit these unrealistic sales quotas, you have to lie and manipulate customers. Therefore, all the upper management are scummy, and then they promote a toxic work culture to anyone below them, and then the cycle continues. There are some videos on YouTube that talk about this. I'll put some of the links in the description below. Anyways, this is a big problem. I said earlier that the quality of the people at a company eventually determines the value of that company. And if there are no talented, hardworking, and honest people working in upper management, then I don't see how this company can survive. And the most worrying thing about this is that I don't see enough people acknowledging that this is a problem. Let's take a quick look at GameStop's financials. Just a quick glance at GameStop's financial statements, and it's clear that GameStop is not doing very well. Revenues have declined year over year. Net income has gone massively negative recently, and shareholders' equity is almost non-existent. Luckily for them, the new console cycle will keep GameStop in business for at least the next 3 years. But if GameStop doesn't do anything to change, eventually they will end up in bankruptcy. GameStop has to figure out something new, and it's not like they have a ton of money to do so. I think they have about $300 million to figure something out, which sounds like a lot of money, but it's not that much money. If you think about the whole Blockbuster versus Netflix situation about 10 years ago, in order for Blockbuster to survive, they probably would have had to invest upwards of $1 billion to compete against Netflix, and then additionally, they would have to forgo profits for many years to come. Blockbuster just wasn't really to make that type of sacrifice. And I'm not saying that GameStop is the same as Blockbuster, but I'm not sure if GameStop is willing to make that big of a sacrifice in order to survive. GameStop might be able to raise additional capital by selling their shares, and at $50 per share, I think it's worth it for them to raise capital at this price, since they'll be able to strengthen their balance sheet without too much of equity dilution to their current shareholders. For example, they can issue 4 million shares at $50 per share, and this would generate $200 million to their cash balance with about a 5 to 6% equity dilution to the current shareholders. It would have been nice if they were able to issue shares at $300 per share, but they weren't able to do so. But like I said, even at $50 per share, I think it's still worth it. Additionally, with this new console cycle, hopefully they'll be able to generate another $100 to $200 million over the next 2 or 3 years, which would then put them in a good financial position to make a big change to their company. So what do I think GameStop is worth? First off, we have to acknowledge that there are big problems with GameStop. The problems are deep, they are internal as well as external. 5 years from now, GameStop could very well be worth zero or very near zero. So that we have to factor that into our calculations. I'll call this as the worst case scenario. However, I do think that GameStop will find a way out of their financial struggles. The market for gaming just keeps getting bigger and bigger every year. And even though PC and mobile gaming is growing more rapidly than console gaming, it's not a zero-sum game, meaning there's room for all markets to thrive. So to come up with what I think is a good case scenario, I did some really rough math. So let's say that GameStop transforms into an e-commerce / brick and mortar hybrid, and they grow revenue at about 10% per year. This year, they're going to make, I think, about $5.5 billion. So 5 years from now, at 10% growth per year, their revenue would be about $9 billion. Now, they are in a very low margin business. In Q4 of 2019, which is their only profitable quarter for a very long time, they made a 1% net profit margin on their revenue. Now, I would say in the very best case scenario, they would be very lucky to get a 3% net profit margin. But let's just say that 5 years from now, they are profitable. They have their economies of scale. They are able to contain their costs, and they make a 2% net profit margin. A 2% net profit margin on a revenue of $9 billion is $180 million. If you assign a 25 price to earnings ratio to that, that means the company would be worth $4.5 billion or about $64 per share. So again, this would be the good case scenario. Now let's just say same scenario, but GameStop figures out a way to add a business line that generates a stream of profits for GameStop, whether it's from esports, from revenue share of digital downloads, or maybe GameStop Studios that develops exclusive gaming content for GameStop. Whatever the case is, let's say that that company generates $1 billion of revenue at a 5% net profit margin. That would add an additional $50 million per year to their net profit. So add that $50 million to that good case scenario of $180 million, and you would get $230 million per year of net income. You would probably assign a higher PE in that situation. So if you assign a 30 PE ratio, you would get $6.9 billion or $98 per share. So we would call this the best case scenario. But just how likely is each scenario? This is just my opinion, but I think that there is a legitimate chance that GameStop would go out of business or be on the brink of going out of business 5 years from now. So the worst case scenario, I would assign about a 35% chance. For the good case scenario, I think out of the three, this is the most likely to happen, and I would assign a 50% chance for the good case scenario. That would leave 15% for the best case scenario. So for the worst case scenario, I assigned a price of 10 cents. For the good case scenario, I assigned a price of $64. And for the best case scenario, I assigned a price of $98. So if you take all these probabilities and you assign them to the worst case, good case, and best case scenario, you get a weighted average of $47. This is what I think GameStop is worth. But all these scenarios are for 5 years from now. So obviously, you don't want to pay $47 for an asset that will still be worth $47 5 years from now. I think a good rule of thumb is to try to double your money every 5 years. this would target about a 14% annual return. So to me, GameStop is worth about $24. Maybe you just want to target a 10% annual return, in which case GameStop is worth $29. I know this is not what you want to hear if you're a Wall Street Bets follower and you bought the stock at over $100. But this is just what I think. Feel free to do your own calculations, but this is just my opinion after weighing both sides. Granted, I do tend to be overly conservative. If you look at my Tesla analysis and my Airbnb analysis, I thought that Tesla would reach a price of $1,000 by the end of 2025, and I thought that Airbnb would hit $240 by the end of 2025. But at the rate that they're growing now, they're probably going to hit those targets by the end of this year. So again, take my numbers with a grain of salt. Let me know what you think in the comments below. If you enjoyed this video, give this video a like or subscribe so that YouTube will continue to push my videos out to you. As always, thanks for watching, and I'll see you in the next video.